Hello, everybody. This is Jarek Ruiz, apartment broker and tax strategist with eXp Realty Commercial, and I'm super stoked today to be interviewing Mr. Kyle Baska from the Karla Dennis firm. And Kyle Baska is the tax strategy manager at Karla Dennis and Associates Inc. He is a enrolled agent and he specializes in putting together customized tax plans for his clients. Kyle's clientele is comprised of business owners and real estate investors. After completing hundreds of tax plans, he's become an expert in identifying and implementing strategies that puts his clients in the best position possible to reduce their future tax burden. So, Kyle, welcome.
Thank you, Derek. It's a pleasure to be here. Thank you for having me.
Absolutely. We met at the Apartment Owners Association landlord exhibit and conference a couple of weeks ago in Long Beach, and that's where I met Kyle. And when I heard what he and his firm does, I'm like, oh man, I have to interview you and share your information with my database of investor clients and landlords. So here we are, finally at the Zoom meeting. So let's see. I Tell us a little bit about your firm.
Of course, yeah. So Karla Dennis and Associates Inc. is located in Southern California, around the La Palma Cerritos area, if you're familiar with it.
Yeah.
We've been around for over 30 years now, founded by Karla Dennis, who is actually coined America's tax lady. If you type in Karla Dennis into Google, you'll instantly see a couple news clips of her frequently going on local television stations, doing road shows, travel events, always speaking at conferences in relation to tax planning and tax strategy. And this is what she has been doing now for over 30 years. She now has a family run and operated firm where she has all four of her sons working in the firm, Karla Dennis and Associates. And over the years, Karla has perfected the tax planning process, which is vastly different from what most business owners and real estate investors do, which is just tax preparation. The key difference between planning and preparation is one is more so reactive, the other is proactive. If you're waiting until the months of January to April to think about what occurred the prior year and making sure that it's all accounted for appropriately on your tax returns, at that point, you're just staying up to compliance. There's really no flexibility with ways that you can then reduce your tax burden at that point because we're outside of that calendar year. And Karla realizes this, and that's why she has this importance of making sure you're making the right decisions before the end of the year via tax planning.
So, okay, so let's just segue to what services exactly does your firm offer rental property owners and landlords and investors? Because that's the main audience for this Zoom recording
Yeah.
is rental property owners, investment property owners, commercial, multifamily, industrial, warehouses, any kind of investor. What are the services you provide specifically to that group?
Of course. So think of this firm as more so of a one-stop shop. So as a real estate investor, you'll of course want to factor in tax planning, tax preparation, bookkeeping, processing payroll if you're leveraging management company type strategies. Of course, performing cost segregation studies, which we'll get into, ways for us to help accelerate depreciation on those real estate investment properties. And then aside from that, setting up certain strategies like nonprofits, private family foundations, which we'll also get into in terms of ways to defer capital gains or reduce capital gains taxes if you were to ever sell certain assets like real estate properties. So, well, the way that we initially work with our clients, though, especially on the real estate side, is we first focus on tax planning. And we do this because there are certain strategies that, as a real estate investor, you have access to that the typical W 2 employees and most business owners can't qualify for. If you're looking for the true flexibility in the tax codes, It's by being a real estate investor.
Got it. Okay. So you're like a full service when it comes to accounting and tax planning and stuff for real estate investors.
Yep.
Oh, Kyle, one thing I wanted to ask you too, because a lot of people don't know this, and I'm not that familiar with. You're an enrolled agent, correct?
Yes.
What define that for the audience? What exactly is an enrolled agent?
Of course, yeah. So just like Karla as well, the founder of the firm, we are both enrolled agents. An enrolled agent is the highest designation in the eyes of the IRS as it relates to tax law. So think of an enrolled agent as a higher designation than a CPA, primarily because an enrolled agent is also allowed to represent a client in the event of an audit. And for all of our real estate investors out there, the best approach is to always plan effectively in the event an audit were ever to occur. That's why documentation is, of course, very important with some of the strategies that we work through. But going back to an enrolled agent, not only are we able to represent clients in the event of an audit, but we specialize in tax law. That's the key difference between a CPA and enrolled agent. A CPA is more broad focused. Of course, you know, CPAs is making sure everything's properly accounted for in something like a tax return. An enrolled agent is more so that tax strategist, helps identify and implement strategies to implement before the end of the year. That's my role.
Yeah, I've have a lot of investors that have CPAs and they're not all that happy with them. A lot of my
Yep.
investor clients say all they do is take my all my information I give them at the end of the year and they just punch everything into the computer and whatever the computer says, that's what the CPA says I owe. And there's not a whole lot of strategic thinking or planning with that approach.
Exactly. And that's, I'll be honest with you too, that's how we earn the majority of our business. It's because our clients are so used to being in this endless cycle of they wrap up the calendar year, they input their numbers and they provide their financials to their CPA or tax preparer, and then all of a sudden they're faced with a tax bill. So that's the loop we're trying to break.
Okay, great. Well, let's talk a little bit more about cost segregation and tax strategies for deferring or eliminating capital gains taxes. Um, I've always been looking for good strategies for deferring capital gains taxes for my sellers because most of my sellers are in their 70s or 80s. They've had their property for a long time. They have a very small basis because they bought the property 20 or 30 years ago.
Okay.
And now that they are, wanting to retire, their kids don't want the property, they're sick and tired of management, they want to sell and retire to somewhere warm and sunny. But when they look at that 35, 40, 45% capital gains tax bill, they're like, whoa, there's got to be a solution to that. So I'm always on the lookout. And when I met you, I was very intrigued by the cost segregation part of the strategy as well as the other depreciation strategy. So why don't we talk about the
Yeah.
what exactly cost segregation is and how it helps investors?
Of course. Well, so the primary goal or target of having rental properties or just real estate investment properties, at least for the tax strategy side of things, is taking advantage of depreciation.
Mhm.
Because every single year, as long as we have a true rental property in the portfolio, you can account for depreciation, and the depreciation of that building is a phantom expense. It's not something you're paying into every single year, yet you get to account for it on your tax returns. So if we're thinking about the typical time frame that the IRS allows you to depreciate your building, for residential properties, it's over 27 and a half years. For commercial properties, it's over 39 years. And the key part to focus on is that it's only the value of the building, not the building and the land. That's important. But when we're looking at a cost segregation study, that's what allows us to accelerate the depreciation on that building within shorter time frames. So instead of us just taking a chunk of the depreciation every year over 27 and a half years for a residential property, now we can accelerate the depreciation in much shorter time frames because we know that certain components in each of these buildings last different time frames. meaning that they have different useful lives. So let's think about it this way. If the kitchen countertops, the drywall, the paint, the lighting fixtures, even the nuts and the bolts within each of your properties, they're not going to last the full 27 and a half years. They're more likely to last 5, 7, 10, or 15 years. Now, with this cost segregation study, it allows us to take those components, but put them in these different buckets with different useful lives and accelerate that depreciation all within, in most cases, the first year. Now, what this could lead to is, let's just say you just acquired a rental property or you're within your first couple years of owning this property. That's when a cost segregation study is most beneficial because there's that much left depreciation for you to accelerate. And in a year like 2022, let's just say this is the first year that you're taking depreciation on a property, you can accelerate between up to 30 to 35% of the value of the building in its first year of rental use. Now let's go through the scenario of, let's just say you have multiple rentals and you're looking to sell one of your properties, and maybe you've just recently acquired a separate property. The capital gains you might be faced with by selling one of your rentals, you can offset with the accelerated depreciation and losses from another rental property.
Okay, wait, hold on one sec. So right
Yeah,
now you're talking about cost segregation, and you're going to
yeah,
segue over to using the depreciation to offset capital gains taxes, correct?
yep,
Okay, I just wanted to just finish out the cost segregation
of
portion of the
course.
discussion. So instead of having a 27 and a half year depreciation on the new 12 unit apartment building that your investor just bought, you could potentially squash down that depreciation schedule to how many years?
Well, so we would essentially be front loading a certain amount of that depreciation within 1 year. And then with whatever depreciation is left after that accelerated portion will then be spread out for the remainder of that time frame. So it's more so a way for us to front load a certain amount and then continue to space out the remaining amount.
Oh, so it's all taken in that first year, most of it?
So up to, at least for 2022, you'd be able to take about 35%.
And how does that impact your taxes?
So think about it this way. It does depend on what kind of strategies you're able to qualify for. Because if, let's just say, you are playing an active role in managing your rental portfolio and this is your main source of income,
Right.
there's a fairly high likelihood that you are going to be able to qualify as what's called a real estate professional. That's when things get a little bit more complicated, but very beneficial. Because to qualify as a real estate professional, you need to be able to show on paper through a log booklet that you are spending 750 hours materially participating and running your portfolio, by also making sure that you're spending more time on average in your portfolio versus any other source of income. If you fit those two tests, you qualify as a real estate professional. Now, the benefit of doing so is that we all know that with your rental properties, you're generating passive income. Now, passive income, it stays within what we call the passive income bucket. So let's just say that you performed a cost segregation study on a rental, accelerated this depreciation, and now you're showing an overall loss on that property. If we don't qualify as a real estate professional, then that loss stays labeled as a passive loss, meaning that we can't carry it over to any other forms of income. But if you do qualify as a real estate professional, we're then able to reclassify the passive income to non-passive income. And once you do that, now you've unlocked this ability to carry all of these excess losses from your rental portfolio over to your other sources of income. So I'm talking business income, maybe any W-2 or part-time income, any capital gains, any other type income you can now use and offset with your real estate losses.
Okay, so all right, I get it. It's a little complicated probably for most of us, but it's understandable to a point. So this cost segregation strategy, is really for properties that are just purchased or within a year or two?
It's more beneficial with depending because we want to take advantage of how much depreciation is left.
Okay,
So in cases where, let's just say you've already been depreciating the property for 15, 20 plus years, there might not be as much of a need to perform a cost segregation study because there's not that much left depreciation to accelerate. At that point, if you're looking to try to sell a property or offset capital gains from a property you've owned for quite some time, that's when you want to look at how much appreciation you have in your other properties, or you consider alternative strategies like 1031 exchanges, investing into opportunity zones, or considering the nonprofit type angles, which we can also get into.
okay, so, all right, so let's segue from cost segregation. So the main, I guess the main, or the best, or the target investor for this would be somebody that manages a portfolio full-time. And but what about somebody that's had a portfolio, but they haven't bought anything for a long time? It doesn't seem as it doesn't seem like it would be as helpful for them.
On the cost segregation study, likely not as beneficial. That's why we'd want to identify alternative strategies that are based off the goals that my client would share with me.
Okay,
So,
so
yeah,
let's go ahead and segue into the other tax strategies for deferring or eliminating capital gains taxes. We know cost segregation is really for investors who are buying properties now going forward to set that strategy in motion now. So let's talk about the investors who've got a portfolio of properties or even one property, and they want to eliminate their capital gains taxes or defer them actually. What what are your thoughts on that?
yeah, I'd say the number one priority would be to consider 1031 exchanges. So if you're looking to defer the capital gains on a property that was truly labeled as a rental, you can use a 1031 exchange, which is referenced as a like or kind exchange, meaning that you can exchange this property into one or a couple properties that are of the same or greater value. And as long as you fulfill certain guidelines, you're able to defer not only just the capital gains taxes, but all of the depreciation recapture that you might be faced with without a 1031 exchange.
Right. And, most of the investors watching this Zoom video are fairly sophisticated, and a lot of them have probably done 1031 exchanges, or
Good.
at least they're familiar with 1031 exchanges. They've been around a long time. It's very common.
Hmm.
But what about the 84-year-old woman who has a very low tax basis? Her health may not be that great. Her kids don't want the property. She just wants to retire and minimize her taxes. What would you say in that situation?
Yeah. So I'd say at that point, you're likely going one of two routes. You're either going the opportunity zone type of investment, where you would be able to sell the property, realize the capital gains, and move the entire amount or a portion of the capital gains into a qualified opportunity zone. And these qualified opportunity zones, they are easily found and discovered by just searching online. But the purpose of them is that you can defer the capital gains owed on the sale of that property by pushing these funds inside the zone. But then after 2026, you will be required to pay the capital gains that were deferred. So it's not an indefinite deferral like a 1031 exchange. And at let's just say by 2026, you will be on the hook for paying the capital gains, but then any appreciation in value that you've realized by making that investment into the zone, that is tax free. So that's one route. If you're more so looking to, let's just say, if again the goal is to not, hand this down to beneficiaries, the kids don't want it, of course, there's a way for us to just make sure that the property is owned by a trust. So when the time does come for the property to be handed down, at least there's a step up in basis on the property that avoids going through the whole probate process. The other route to take, nonprofits. So one thing that we help our clients understand is the value of something like a private family foundation.
Yeah,
If you
I'm really interested in hearing about those, and I have a lot of clients that have asked about those. So I'm glad you're able to
Good.
talk about that here.
Yeah, because the overall value and benefit that comes from a foundation like this is that you can move up to 30% of your adjusted gross income every single year into this foundation completely tax-free. And the only requirement is that you move 5% of those funds to a charity of your choice. Now, one other benefit of a nonprofit like this, no capital gains taxes. So if we wanted to essentially transition the title and ownership from your name in this property to the foundation, and the foundation is what sold the property, no capital gains. Now the questions come about though around how to access those funds. With a nonprofit, a foundation like this, the goal does need to be that this is for you to build a legacy. This is something that the funds in the foundation will primarily be used for charitable reasons. So if that is a goal, if you already have in mind some kind of charitable organization that you want to have in place, you want to donate to, this is absolutely a route to take. And you can also add family members on payroll as another way to access these funds. So let's just say you want to put your children, your grandchildren, your aunts, your nephews, nieces, all of it. You can put them on payroll, provide them a W-2 salary for working within your own nonprofit.
Great. That's a brilliant idea for some investors, I'm sure.
Yeah.
Great.
Especially with the time that we have left in the calendar year. I mean, this is a very common strategy. If you're looking at some capital gains, you're still trying to offset and reduce, that strategy is something that's very commonly used by closer to December 31st.
Great. Tell me, Kyle, what is your ideal client look like?
I'd say ideal client is, of course, it's a real estate investor. If you own rental properties, again, that's where that true flexibility in the tax code comes from. I'd say, of course, there is flexibility if you are content with your existing portfolio or trying to consolidate or liquidate. If you have plans on continuing to acquire properties, that's where more benefits come from. But at the end of the day, if your real estate portfolio is your main source of income, depending on how much depreciation you have left in your properties, my goal is to have that income be as close to as little as tax-free as possible. That's the goal as a tax strategist. I want you to have tax-free wealth because it is never going to be about how much you make. It's all about how much you keep.
Great. Well, I think that's a great way to end our conversation. So, Kyle, I want to thank you again for giving us your time and helping educate investors that are watching this video. And of course, folks, I'll have all of Kyle's information down below this video. I think he's a great resource. I'm so happy to have met him at the AOA Landlord Conference. Him and his firm are obviously a wealth of knowledge for real estate investors. And my goal in communicating with you all is to bring you relevant, important information that helps you as a real estate investor. So again, Kyle, thank you so much. This was wonderful. I know we'll be doing business in the future, and hopefully a lot of people watching this video will reach out to you for some help and guidance.
Absolutely. I'm more than happy to offer free 30-minute consultations to whoever wants more information. Just follow the contact information that Derek provides you.
All right, everybody, this is Jarek Ruiz, apartment broker, eXp Realty Commercial. Thanks for watching. We'll see you soon.
All right.